TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Imagine you're looking at a stock market that is up like 18% in just 2 months.
Which is massive.
Right. You check your portfolio, the screen is flashing green, and everything just looks invincible.
Yeah, totally bulletproof.
Exactly. So it's late May 2026, and the S&P 500 is riding this incredible, almost gravity-defying 8-week winning streak.
It's just wild to watch.
It is. I mean, the prevailing narrative is pure, unadulterated, buy everything euphoria.
Oh, absolutely.
But if you look under the hood on a single Friday during this run...
And this is where it gets crazy.
Right. The smartest players on Wall Street secretly spent $16 billion betting it's all going to crash.
Yeah, $16 billion.
So today, we are opening up the data to find out why.
It is, it's just a phenomenal contradiction to unpack.
Yeah, so where do we even start with this?
Well, we're pulling from a stack of daily notes from SpotGamma,
Okay.
spanning May 18th to May 22nd, 2026. And the overarching theme across all of this proprietary data, it's basically a silent war playing out in the markets.
A silent war. I like that.
Yeah, because we have this AI mania dominating the headlines and the surface pricing.
Sure, everyone's talking about AI.
Right. But it's going head-to-head with this deep, hidden macro fear that's just brewing in the derivatives market.
So let's treat this like we're trying to, read the Matrix.
Oh, I love that analogy.
Because you have what the ticker tape is telling you on your TV screen.
Yeah.
The green numbers, the daily highs, the talking heads just celebrating.
The surface reality.
Exactly. And then you have what the institutional money is actually doing in the background.
Which is a completely different story.
The contrast is staggering.
Right.
But to understand it, I feel like we need to start with that surface reality.
For sure.
Because for you, the listener, if you just have your retirement savings in a standard index fund, this market looks, well, bulletproof.
Yeah, it does.
So why is the market just refusing to fall, even when there are obvious economic headwinds and bad news floating around out there?
Well, to understand the surface invincibility, we really have to look away from traditional economic fundamentals.
Really? Ignore the fundamentals.
Completely. We have to look strictly at the mechanics of the options market.
Okay, play it on me.
The SpotGamma notes point to this massive wall of what they call positive gamma.
Positive gamma.
Yeah, and this dynamic is driven entirely by market makers.
Okay, hold on. I want to make sure we don't lose anyone in the jargon right out of the gate.
Fair enough.
What does positive gamma actually mean for the everyday functioning of the stock market?
So market makers are the massive financial institutions that facilitate your trades.
Right.
When you buy an option, you usually aren't buying it from another retail trader. You're buying it from a market maker who takes the other side of your bet, to provide liquidity.
Okay, so they're the counterparty?
Exactly. And it really comes down to how these market makers manage their own risk.
Because they don't want to lose money.
Right. A market maker doesn't want to gamble. They don't actually care if the stock goes up or down.
They just want to collect the fee.
Precisely. They just want the small fee, the spread, for making the trade happen.
Makes sense.
So to ensure they don't lose money, if the market suddenly swings against the options they just sold, they have to hedge their positions.
By doing what?
By buying or selling the underlying stock.
Okay.
And when the overall options landscape puts these market makers in a state of positive gamma...
Which is where we are right now.
Right. The mathematical calculus of their hedging algorithm literally forces them to buy stocks when the market dips.
Wow.
And sell stocks when the market rallies, purely to keep their own books neutral.
So they are just mechanically trading against the momentum.
Exactly.
They aren't doing this because they, read a good earnings report or think a stock is undervalued. It's pure automated risk management.
It is. It's algorithms. And when you have trillions of dollars in the options market, this automated hedging has a profound effect on the broader stock market.
Because it's so much money moving around.
Right. It acts as a massive shock absorber. If bad news hits and retail investors start panic selling, the market drops a little.
Yeah, sure.
But that drop triggers the market makers' algorithms, forcing them to step in and buy massive amounts of stock to re-neutralize their hedges.
And their buying absorbs the selling pressure.
Exactly.
It's like falling into a giant foam pit at a trampoline park.
Oh, that's a great way to put it.
Right. No matter how much selling pressure hits the market or how high you jump from, this automated options positioning just absorbs the impact.
Yep. You sink in a little bit, but the foam instantly pushes back.
And it bounces prices right up into a tight sideways range.
Exactly.
You can't crash. You just get stuck in the foam.
The foam pit analogy is perfect for a positive gamma environment. And the foam is incredibly thick right now.
I bet.
But what the data shows us is why the market is so eager to stay playing in that foam pit rather than taking profits after an 18% run.
Right, because normally people would take their money off the table.
Exactly. But the sources point to two massive catalysts keeping traders aggressively locked into the market.
What are they?
First, we have the NVIDIA earnings report on Wednesday, May 20th.
Huge.
And second, there is the heavily anticipated SpaceX IPO slated for June 12th.
Oh, wow. The AI and tech hype engine is just running on maximum overdrive right now.
It really is.
I mean, SpaceX entering the public markets is like dangling the ultimate shiny object in front of tech investors.
Oh, absolutely. Nobody wants to be sitting in cash when a historic IPO hits.
Oh, wait.
And the data around the NVIDIA earnings setup illustrates just how deep this FOMO, the fear of missing out, really goes.
Okay, what does the data show?
Going into that May 20th report, the call option skew was sitting in the 99th percentile.
Whoa.
Yeah. Meanwhile, the put option skew was sitting at the 30th percentile.
Wait, let's break that down. Skew in this context is measuring the demand difference, right?
Right.
Between call options, which are bets the stock will go up, and put options, which are bets it will go down.
Correct. It essentially measures how expensive calls are relative to puts.
Okay.
So when call skew is in the 99th percentile, it means investors are willing to pay historically exorbitant premiums just to get a piece of the upside.
They are climbing over each other for lottery tickets.
Literally.
But wait, 0th percentile for the
Yeah.
puts. Just be clear, does that mean literally no one was buying downside protection?
Basically, yeah.
Is that even mathematically common on a multi-trillion-dollar company going into a highly volatile earnings report?
It is exceptionally rare. It means the options market for NVIDIA was completely binary.
Wow.
Institutional and retail traders alike were treating downside risk as if it just didn't exist.
Like it couldn't go down.
Right. The sentiment was essentially, fire insurance is a waste of money because this house cannot burn down.
That brings up a massive contradiction, though.
How so?
Well, you just laid out a scenario where traders are throwing all their money at call options, driving the price up, and the market makers are in the foam pit catching any minor dips. It sounds completely bulletproof. But you open this deep dive by saying Wall Street is secretly terrified.
I did.
If nobody's buying insurance on the biggest tech stocks in the world, where is the real hedging happening?
That is the big question.
Because historically, right, if institutions are scared of the broader macro picture, they don't even bother with stock options.
All right, they do something else.
They just cycle their billions into government bonds.
And that is exactly where the dynamic shifts from tech euphoria to macro terror.
Okay, explain that.
Because historically, you were completely right. Government bonds are the ultimate safe haven.
Yeah, the classic 60-40 portfolio.
Exactly. 60% stocks, 40% bonds. When the economy stumbles and stocks fall, investors rush to the safety of bonds.
Which drives bond prices up.
Right, and that offsets your stock losses. But the sources highlight a fundamental breakdown in the modern market.
What's the breakdown?
The traditional safe havens are broken.
Broken in what way? Like the bonds are defaulting.
Oh, no. The sovereign debt isn't defaulting. The mechanism of the hedge itself is broken.
Okay, why?
Because of inflation and geopolitical tension. The SpotGamma notes specifically cite the escalating Iran situation and sticky, persistent inflation.
Ah, the macro fear.
Right. Usually, if the stock market starts looking shaky because the economy is slowing down, the Federal Reserve will cut interest rates to stimulate growth.
Sure, standard playbook.
And when interest rates go down, the fixed yield on existing government bonds becomes highly attractive.
So bond prices go up.
Exactly. Stocks go down, bonds go up. They are inversely correlated.
But right now, the fear isn't just a slowing economy.
No.
The fear is that inflation is going to stay high, especially if geopolitical tensions in the Middle East cause a massive spike in oil prices.
Exactly. And if inflation stays high, the Federal Reserve cannot step in to cut rates to save the stock market.
They might even have to raise them.
Right. They might be forced to keep rates high or raise them further to combat that inflation.
And when interest rates go up,
The value of existing bonds drops significantly.
ouch.
Simultaneously, high interest rates choke off corporate borrowing and compress stock valuations, causing equities to drop.
So they both drop.
Yes.
Hmm.
Because of this inflation threat, equities and rates have become positively correlated.
Man, it's like being in a twin-engine plane.
Okay.
Usually, if your stock market engine fails, your bond market engine keeps you flying safely.
Right.
But right now, a fire in the stock engine is actively spreading to the bond engine. They are taking each other down.
That's a terrifying visual, but yeah.
Pulling that bond lever doesn't save you, it just accelerates the crash.
And that is the exact mechanical nightmare facing portfolio managers right now.
Wow.
And it forces us to ask, if the smart money knows their bond engine is compromised, what on earth are they doing to survive the turbulence?
Right, because they still have billions of dollars of exposure to the stock market.
Exactly. They can't afford to miss the 18% NVIDIA-driven rally. They'd lose their jobs.
So they need a new way to hedge. What does the data say they are actually buying to protect themselves, if not bonds?
They are shifting to entirely different, highly asymmetrical assets.
Like what?
The daily notes track 3 very specific trades happening in massive volume behind the scenes.
Okay, what's the first one?
First, they are aggressively buying crude oil.
Oil.
Yeah. Oil is currently cruising above $100 a barrel.
Wow.
The logic here is a direct hedge against the geopolitical catalyst.
The Iran situation.
Right. If the Iran situation escalates and blocks supply chains, oil will spike violently,
Which causes inflation.
which will crash the stock market.
Oh, I see. By owning oil, you profit from the exact catalyst that destroys your equities.
Exactly.
Okay, that makes mechanical sense.
Yeah.
You are basically buying the poison so you have the antidote.
That's one way to look at it.
What's the second trade?
Second, they are making massive bets on deep out-of-the-money VIX calls.
The VIX, the fear gate.
Right. It measures the market's expectation of near-term volatility based on S&P 500 option prices.
Where is it sitting right now?
Throughout this May 18th to 22nd period, the VIX is sitting quietly around 17 or 18.
Which is pretty calm, right?
The market looks perfectly calm,
Yeah.
but institutional traders are buying massive blocks of VIX call options, specifically targeting the 35 strike for August.
Okay, let's clarify out of the money for a second. The VIX is at 17.
Yep.
They are buying options that only really pay out if the VIX hits 35 or higher by August.
Exactly.
They are betting the fear gauge is going to literally double in the next 3 months.
Yes, they are.
That's insane.
Well, an out-of-the-money option is essentially a low-probability, high-reward bet.
A lottery ticket for a crash.
Basically. Because the market is so palm right now, those 35 strike calls are incredibly cheap to buy.
Ah, so it's a chief hedge.
Institutions are paying a tiny premium for a catastrophic tail hedge.
Wow.
They're betting that between now and August, the foam pit is going to vanish and panic will double.
Okay, and what's the third trade?
Third, they are buying put spreads on IWM.
IWM, which is the ETF that tracks the Russell 2000, the small cap index.
Right.
But wait, if they are worried about the whole market crashing, why are they specifically targeting small cap companies for their put options?
It's a great question.
Why not just short the S&P 500 directly?
Because small companies are the most mechanically sensitive to inflation and high interest rates.
Really? More than the big guys?
Oh, absolutely. If you're Apple or Microsoft in the S&P 500, you have billions in cash reserves.
Right.
You don't need to borrow money at 7% interest to make payroll.
Yeah, that makes sense.
But a small cap manufacturing company in the Russell 2000, they rely heavily on constant floating rate debt to operate.
Ah, so high rates crush them.
Exactly. SpotGamma tracked a single trade of about 55,000 IWM put spreads, where an institution paid roughly $9 million in premium.
$9 million just on the premium.
Yep. It's a highly targeted bet that high interest rates are going to bankrupt the smaller guys long before they dent the tech giants.
Wow. So the picture we have is totally split.
Very much so.
On the surface, everyone is cheering NVIDIA, putting on their SpaceX hats, and enjoying the ride up.
Right.
But underneath, the institutional players are quietly hoarding physical oil.
Yep.
Betting the fear gauge will double.
Yeah.
And actively shorting small businesses. It's two entirely different realities.
It is. But all of this background activity, the oil, the VIX, the small caps, that was really just the warm-up for what happened on Friday, May 22nd.
Okay, the climax.
This is the absolute climax of the data set,
Yeah.
and where the paradox becomes literally impossible to ignore.
Walk me through Friday. What did SpotGamma find?
So on Friday, the S&P 500 closed up for the day.
Okay, green day.
It gained about 0.37% and closed at 7,473. The ticker tape is green. The 8-week winning streak is perfectly intact.
Nothing to see here, folks.
Right. But underneath the hood, the SpotGamma systems track a metric called HIRO, indicator flow.
HIRO.
Yes. This measures cumulative aggressive customer options trading.
Okay.
And on that Green Friday, they recorded a massive negative $16 billion in delta flow on the S&P 500.
Okay, let me stop you there. For the listener who isn't a derivatives trader, what exactly is delta flow representing here?
Sure. So delta is a ratio.
Okay.
It compares the change in the price of an option to the corresponding change in the price of the underlying stock.
Okay, I think I've got it.
Think of it as stock equivalent exposure.
Stock equivalent exposure.
Okay. If you buy a bunch of put options, betting the market will go down, so those options have a negative delta.
Right.
What the HIRO indicator does is translate all the millions of complex option trades happening in dark pools and exchanges into their actual stock footprint.
Got it.
So negative $16 billion in delta flow means that on Friday, the options market saw an influx of bearish bets equivalent to someone dumping $16 billion worth of actual S&P 500 shares.
Wait. If $16 billion of stock equivalent pressure is actively betting against the market in a single day,
Yeah.
how on earth is the ticker tape still printing green?
It's crazy, right?
Who is absorbing that massive amount of selling without the price crashing?
This brings us right back to our foam pit.
Oh, the market makers.
Exactly. The positive gamma from the market makers is so thick right now that it is actively absorbing that $16 billion of selling pressure.
That is insane.
As the institutions bought those puts, the market makers who sold them had to adjust their hedges.
And their automated hedging kept the price up.
Paradoxically, yes, it helped keep the surface price stable.
Wow.
But the sheer volume of that negative flow, which consisted of about $9 billion in put buying and $8 billion in call selling, tells us exactly what the big institutions are doing.
It was a massive bet.
It was the largest single-day negative reading in the last 30 days.
It's just wild. Buy everything on the surface, hedge everything in the background. They are riding the NVIDIA wave because if you're a mutual fund manager, you will get fired if you miss an 18% rally.
Absolutely. You can't sit it out.
But they are absolutely terrified of the macro setup, so they're secretly buying $16 billion worth of downside insurance for when the music stops.
That is the core insight of this entire data stack. It is a schizophrenic market.
Okay, so if you are an informed listener looking at this data,
Yeah.
how do you actually navigate a market that is fundamentally lying to you on the surface?
It's tough.
If you know there's a $16 billion monster hiding under the bed, but the market just keeps going up every single day, how do you protect your own portfolio?
The sources are very clear on this.
What do they say?
You have to detach from the narrative and look strictly at the mechanical levels.
Okay.
SpotGamma identifies a very specific critical line in the sand for the S&P 500 based on where all these options are clustered.
A line in the sand.
They call it the SPX risk pivot line.
Risk pivot.
And during this specific week in May, that risk pivot is sitting exactly at 7,390.
Why 7,390? What makes that specific number the line in the sand?
That 7,390 level represents the center of gravity for the market maker's gamma positioning.
Okay.
If the S&P 500 is trading above 7,390, the market makers are in positive gamma.
They're in the foam pit.
Exactly. They are suppressing volatility and buying dips. The rule for traders is crystal clear.
Which is?
If the market is above 7,390, the outlook is strictly bullish.
Don't fight it.
Right. You do not aggressively short this market just because it feels too high or because you know about the $16 billion in hidden puts.
Because the algorithms don't care about your feelings.
Exactly. As long as the index sits above that risk pivot, the automated buying from market makers will relentlessly crush anyone trying to bet against the trend.
So you don't fight the foam.
Never fight the phone.
You hold your nose, stay long, and respect the mechanics.
That's the play.
But what happens on a minute-by-minute basis within that foam pit?
Well, that's where it gets really mechanical.
Right. If fundamental news doesn't matter, what is actually moving the prices during the trading day?
This is where we see a fascinating market mechanic called seek and destroy.
Seek and destroy.
Yeah, and it's heavily driven by zero DTE options.
Zero DTE. That stands for 0 days to expiration, right?
Yes. These are options contracts that expire on the exact same day they are traded.
Okay.
And because they expire so quickly, they are highly leveraged and create massive temporary gravitational pulls in the market.
Okay, wait. How does an option expiring in a few hours manage to physically move a multi-trillion-dollar index like the S&P 500?
It is all about the feedback loop of the market maker.
Walk me through it.
Let's use a specific example from Wednesday, May 20th. Early in the day, institutional traders piled into a massive 5,000 lot call spread specifically at the 7,415 level on the S&P.
Okay, 5,000 calls at 7,415.
Now, when a market maker sells those 5,000 calls, they have to hedge by buying some of the S&P 500.
To stay neutral.
Exactly. But here's the trick with zero DTEs. As the S&P 500 naturally ticks up closer to that 7,415 strike price, the probability of those options paying out skyrocket.
Right, because time is running out.
Yes, and this causes the delta of the options to increase rapidly.
And because the delta increases, the market makers' automated systems realize they don't have enough stock to stay neutral anymore.
Exactly. Well, the market maker is algorithmically forced to buy more stock.
Which pushes the price up.
That buying pushes the S&P 500 even higher, closer to 7,415, which makes the options even more likely to pay out.
Which forces them to buy more stock?
Yes, it creates a self-fulfilling feedback loop that physically draws the market price directly toward that 7,415 strike.
That is wild. It's like a sci-fi tractor beam.
A tractor beam is a perfect analogy.
Right, but one powered by algorithmic panic.
Exactly.
You fire this massive 5,000 lot option into the market at 7,415, and the resulting delta hedging loop just locks onto the S&P 500 and pulls it relentlessly upward until it hits the target.
That is exactly how it functions intraday. And what is really interesting is what happens after the tractor beam pulls the price there.
What happens?
Once the S&P 500 hits 7,415 that Wednesday afternoon, the mechanics flipped.
Flipped how?
The options were now in the money. The market makers had finished their buying.
Okay.
So that 7,415 level instantly transitioned from being an upside target, a resistance level, into a hard support floor.
Oh.
The market makers' hedges essentially cemented that price in place, killing volatility for the rest of the session.
Wow. It fundamentally changes how you view the stock market.
Doesn't it?
You start to see it less as a reflection of corporate earnings or economic reality,
Right.
and more as this mechanical pinball machine, completely driven by expiration dates, delta hedging, and strike prices.
When positive gamma is this thick, fundamental news takes a backseat to options mechanics.
The tail is entirely wagging the dog.
100%.
Man, we have covered a massive amount of ground today, pulling back the curtain on some really complex market plumbing.
We really have.
Let's recap the wild juxtaposition of this deep dive.
Sure.
On one hand, you have a market on an 8-week winning streak, up 18%.
Yep.
You have retail traders throwing everything they have at NVIDIA call options, completely ignoring downside risk, and dreaming of the SpaceX IPO.
Pure euphoria.
And the entire surface is being held together by this positive gamma foam pit that algorithmically bounces every dip right back up.
That is the matrix most people are living in right now.
But on the other hand,
The underbelly.
right, the smartest institutional money in the room realizes that their traditional emergency parachute, the 60/40 bond portfolio, is malfunctioning.
Completely malfunctioning.
Because of inflation and geopolitical risks, equities and rates are dropping together.
Yep.
So they're adapting. They're secretly stockpiling physical oil, buying deep out of the money VIX calls, betting the fear gauge will double by August.
Shorting small cap businesses.
Right. And most shockingly, executing $16 billion in negative delta flow on a Friday where the market actually closed green.
It's a lot to take in. The rubber band is being stretched to its absolute mechanical limit in two completely opposite directions.
That's a great way to put it.
And to wrap up our analysis of these SpotGamma notes, I want to leave you with one final forward-looking thread to pull on.
Ooh, okay. Where does this all collide?
The sources map out upcoming volatility spikes tied to some very specific macro data releases.
Which ones?
We are looking at the core PCE inflation report on May 28th
Okay.
and the NFP, the National Jobs Report, on June 5th.
Major data drops.
Right. And right now, options risk premium around these events is highly compressed because everyone feels safe in the positive gamma foam pit.
Right. The shock absorber is thick.
But market maker gamma is tied to expiration dates.
Okay.
It is not permanent. It physically expires.
Wait, so the foam pit eventually evaporates?
Yes.
Oh, man.
So the thought to ponder as you watch the markets over the next few weeks is this.
I'm ready.
If that positive gamma foam pit naturally expires and wears off right, as a surprisingly hot inflation report hits the tape on May 28th,
Oh, no.
And we already know the bond market is positively correlated and cannot act as a hedge.
Right, the parachutes are made of anvil.
Exactly. Will that hidden $16 billion in institutional put options suddenly act as the spark?
Wow.
Will the market makers, who are no longer suppressing volatility, suddenly be forced to sell into a falling market to manage their risk?
Turning a minor, ordinary pullback into a violent, cascading crash.
That's the question.
That is a sobering mechanism to think about.
It really is.
I mean, if the foam pit disappears and the retail investors pull their ripcord only to find their bond engines are on fire,
yeah.
that $16 billion bet against the market is going to pay out astronomically for the institution.
Right, while everyone else hits the ground.
Wow.
It is the exact mechanical unraveling the smart money is quietly positioning for behind the scenes.
It's all just math.
Right. The options data is showing us two realities, and eventually the math dictates that they have to reconcile.
Well, on that slightly terrifying but incredibly illuminating note, we're going to wrap up today's deep dive.
Thanks for having me unpack this.
Thank you so much for joining us as we peeled back the ticker tape to look at the hidden machinery driving the market.
It's been fun.
The surface might look completely invincible right now, but as we've seen, it always pays to know exactly where the smart money is hiding their parachutes.
Definitely.
Stay curious, keep reading the Matrix, and we will catch you on the next deep dive.